start with the ICI logo.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Welcome back, all of you. And today is one of the very important practical topic. And with me is the faculty of the session, CA Nikhil Kshirsagar. Welcome, Nikhil, to this particular session.
Thank you, Chintan.
Coordinator with us, CA Hiram Inamdar. Welcome, CA Hiram.
Thank you, sir.
And welcome to all of you to the series of session. And as I mentioned, that today's topic primarily includes two very important things. First is determining materiality. So materiality is something which is where practically we are unable to understand how we can determine material. So Nikhil is going to talk about the concepts of materiality. He is also been a part of the process of determining a tool of materiality for institute. And he will have a process walkthrough explaining the use of template and case study. Okay, how can we practically use and determine materiality? I know, understand that for determining materiality, we have always questioned that whether shall I take a turnover or a profit factor, what should be my tolerance error. So a lot of things are there, even of sampling also same way. So sampling is also the part of the process walkthrough use of case study. So these both concepts are something where we are required to use at every audit. It is not something only for a large company. For every audit where it is a test check basis, we need to look at the materiality and sampling both. Materiality also helps us to decide what opinion we should provide. Is it affecting true fairness or not? So these both things are critical, and I'm sure that we are with the Nikhil, who is having a lot of experience on these aspects, involved into this area, and I'm sure that we are going to get a very good practical explanation of this concept. How can we use it? And how can we use the tools which are provided by ICI already? And that is what we are looking for you, Nikhil. And not taking much time further, I request the coordinator of the session, CA Hiram, to introduce the faculty.
Thank you, CA Chintanji, for setting the pace for the session. Let me introduce Mr. Nikhil Kshirsagar. He is the speaker. Of course, he is the speaker for the session. He is a seasoned chartered accountant. With an impressive 14 years of experience in statutory audits, Mr. Kshirsagar has successfully led audit assignments for both large global conglomerates and mid-sized businesses across a diverse range of industries, including automotive, captive, power, steel, chemicals, IT, and software. His approach to leadership is rooted in entrepreneurial principles, focusing on the highest quality standards, exceptional client services, and effective people management. Some of the key assignments of Mr. Kshirsagar he has handled includes extensive experience in Ind AS and IFRS audits since their inception across various clients, managing the transition of Indian GAAP to Ind AS for globally listed entities. Then expertise in project and people management, along with effective networking with experts during audit processes. Currently, Mr. Kshirsagar leads a team of 40 members overseeing various audit engagements. We are honored to have Mr. Nikhil Kshirsagar with us today. We look forward to gaining valuable insights from his vast experience and knowledge. Thank you.
Thank you, Hiram. So with your permission, should I begin?
Please.
Yeah, thank you. Thank you so much. So good evening, everyone. I think thanks, Hiram, for the introduction. I think that's pretty much covered from who I am and brief of my background. So as Chintan mentioned that I'll be covering two very key topics in today's session. One is on the materiality and one is on the audit sampling. So these two things. Okay, one thing is we have lot many standards, Indias, which drives us for audit for determining judgment estimates. Okay, we have a lot of technical things which we handle on a day-to-day basis when we are auditing stuff. But I think the basic thing, which we need to understand very well, is on the concepts of materiality. Because overall, for example, if your determination of materiality is not appropriately determined or calculated, so this would impact your overall judgment and your overall opinion on the financial statements. So this is something really, I think, critical topic, which I think which we should start from the planning stage of audit, which the SA also, our standards of auditing also did mentioned. Like we have to start it from the planning stage, and then of course we need to revisit it very regularly on the overall audit time, audit time and audit period of a particular client. And then we of course use it and revise it as and when it's required. Okay, so this is something really critical, and maybe as before we come, and of course the other topic is the sampling. Sampling is again very critical. Of course, nowadays, like we do audits of large companies, large engagements. So we have a lot of data to audit. Okay, so this is the important thing which comes into picture here is on the sampling. We cannot go and audit the data on a 100% basis, or maybe we cannot go and cover all the material transactions. So that is a highly impossible task, considering the current scenarios of the type of industries we handle and type of risks we handle. So the concept of sampling along with the materiality, because materiality is used in sampling determination, etc. So this is again critical, like how a sampling should be performed, how a sampling should be determined to enable us to give a true and fair opinion whether the risks of material misstatement, because with our strategy is whether we are covering the risk properly or not. This is something which we would be covering in the today's session. So maybe before I start go into the concept, maybe one thing what we can do, we can keep it a bit interactive. I know this is not a two-way vocal interaction, but you have a chat box here. I would request the participants to post your comments, questions here. So I'd be reading them maybe every intermittently, every 5-10 minutes during the course of this session for the next 1.5 hour or 1 hour 45 minutes. So I'll be reading that, and wherever I could answer, I would be covering those answers as well. Maybe what I do, I'll take a pause of say a minute, and I would request, for example, I just want to understand as per you, what is the concept of materiality, and how it is very critical in the whole audit process. Okay, so if someone, like anyone, can put just one liner in the chat box, maybe I just want to understand your concept and your depth of understanding of this materiality. Maybe if we could take a pause of 1 minute, you could post your messages. Maybe I'll come to know what you are thinking about materiality. Okay, thanks, Noman. Any other comments on? Yeah. Okay, it's a benchmark to identify transaction that will impact the opinion of users of financials. Great. Okay, I think we'll move ahead. Like if any more comments, you are happy, you are free to post it in the chat box. I will run through like as and when we proceed. Yeah. So as I said, I'd be referring to the chat box every like 5-10 minutes. If you have any kind of questions during the session, so I will just you can just post it here. I will just run it through, and I'll be just presenting my screen. I'll share my screen so that. I think that's a good point, Virag, what you have mentioned. Like materiality is not always amount wise, it can be nature wise also. We would be covering that aspect in our session as well. That's a good point. So just if anyone can confirm my screen is visible. Thank you so much. Yes. Yeah. So let's first understand the concept of materiality. So like in as per SA 320, of course, which drives like the concept of materiality, how we determine. I think there are a lot of like guidance material that has that ICI has given to us with respect to the determination of materiality, how to use materiality in evaluation of misstatements. Like planning your audit procedures, planning your nature, timing, extent of audit procedures, etc. So there are a lot of guidance which is available in our database, in our on the ICI database, which you could refer to. And the concept of materiality, like if I just want to cover here, it is required, like it clearly says both in planning and performing the audit. Okay. Firstly, because materiality is something which is really critical for us, like you all mentioned on the chat box, the number is really critical for us to determine whether like anything beyond this materiality level. For example, I am just covering the monetary aspect now. We determine a monetary level of materiality. So, and then anything which goes beyond this may impact the users of financial statement on a decision making of for that entity for which we are determining the materiality. So it's really critical for us to have a very precise materiality which we set at the time of planning. So this is applied by the auditor, like it mentioned in planning stage. I'll come to that. How do you determine the material planning set, and how do you revisit, and how do you perform the audit, and how do you conclude? Okay, this is the aspects which we would be trying to cover, and how the other thing is on the determination of materiality, like how to determine materiality, and what are the types of materiality, and how each type of materiality should be used. Okay, so this is something which I would be covering as part of my session. And also, I think there is a very good template which is available, which is kind of a like utility template, I would say, for determining your materiality, which is available on the ICI website again, which you can use, and which would enable all of us to derive the materiality number for a particular entity basis, the risks basis, the experience, or basis covering all the risk parameters, whatever is required, which would be again, it's mentioned in standard as well. So that there is a kind of enabler which you could use, and then you could determine the materiality, and like what should be the benchmark, etc. So even that we would be covering. I would be presenting the Excel checklist to you on the screen, and maybe I'll just run you through how we would need to read it or fill it. I think that we would be covering in this materiality session. Okay. So here, one is, of course, the concept is both in planning and performing, in evaluating the effect of identified misstatements. Of course, during the audit, when we do audit, we do find a lot of kind of misstatements. Maybe it depends on the entity to entity. For example, if the entity is kind of like very susceptible to the industry risks. Okay, so if any kind of regulatory changes, any kind of some law changes, so this would impact that entity really hard. So this is something which would again like impact our determination of materiality, whether the entity should be classified as a low risk entity, medium risk entity, or a high risk entity. So this is like as I said, like on in evaluating the effect of identified misstatements. So during the course of audit, we come across a lot of misstatements which are either corrected, and there can be some misstatements which are not corrected, and there can be some undetected misstatements. So that is the probability of undetected misstatement, which we should again determine in our calculation of materiality, which again is something which you need to consider. And then forming a opinion on the auditor's report, whether basis the materiality what we have determined and basis the audit procedures and basis the misstatements, or whether they can be misstatements, there cannot be any misstatements. So whatever it is, so when we complete the audit, then we determine whether our opinion should be a qualified opinion or a clean opinion, or it should be a disclaimer or whatnot, basis the number. So again, coming just to reiterate this word, misstatements are material. Like if they individually or in aggregate could reasonably be expected to influence the economic decisions of the users taken on the financial statement. This we are determining the materiality. And there's a lot of professional skepticism, judgment involved here with respect to how what is that percentage. See, SA 320 doesn't like provide any kind of percentages, like what percentage you should use, what benchmark you should use for of course there is a guidance, but there is no a determined percentage. It should be 5%, 10%, 50%, 80%, or whatever. So this is something completely again dependent on the auditor's professional judgment and skepticism, and this depends on industry to industry and basis like the nature and characteristics of the assets and liabilities, or the contents of the balance sheet and P&L. So this is something which an auditor needs to consider while understanding the overall concept of materiality for a particular audit engagement. So now I think there was one point which one comment which was raised with respect to the monetary and non-monetary aspects also. Okay, so materiality again we are discussing on concept first. We'll understand the concept as a whole, then we will proceed with the other details. So it can be materiality can be a monetary thing and non-monetary thing as well. For example, for monetary thing, we as an auditor, we would identify the risk of that particular engagement, whether low, medium, or high, and then we determine the overall materiality. Then we do the performance materiality. Then we allocate the performance materiality, specific materiality, etc. But also there are some account balances. There can be some factors like which would where this materiality concept would not work on a monetary terms. So maybe just to quote some examples, for example, as per Section 197 of Companies Act. Okay, so as per Section 197 Companies Act, the director's managerial remuneration should not exceed beyond 11%, and of course there are some other thresholds at individual level. Okay, so here I think this is with respect to some kind of non-compliance. Okay, where we should not see whether that overall anyway it's not material, so it will not impact the like users as such, because it's not going beyond our overall materiality. But from regulatory perspective and from like a lot of disclosures perspective, it's material, and because you are like the company is breaching the thresholds what is defined, which is governed by the Indian Companies Act. Okay, so and like this is something this is just one example. And also there can be certain again thresholds. For example, director sitting fee. Okay, there is a disclosure requirement that a director commission and director sitting fee should be disclosed separately. So again, here the materiality concept doesn't apply on the monetary terms, but yeah, on the on the non-monetary and on the regulatory and legal compliance point of view, it is really critical. So this is something which I think we all need to understand. It's not only about monetary thing, which where okay we determine the materiality on an overall basis, we do a number and then we proceed. Okay, there are a lot of things. An account like you have to go account caption by caption, like whether there is some like number which is driven by a particular law. For example, it can be CSR as well, like CSR expenditure, which again needs to be disclosed separately. So I think this is something again we need to refer that CSR section 198 again and the CSR section section 35 and all. So this is something which we need to refer and whether we should see whether those are complying those section or not. So this is something which again these are I'm just taking some examples for you to understand the concept. We should not only stick to the monetary numbers, and we should also focus on the non-monetary aspects. So any questions till now? Let me check the chat box. Okay. Okay. No question. Fine. Okay, moving ahead, I think let's cover some like as part of our this session, we will be covering the types of materiality. One is overall materiality, and of course there are a lot of like types and angles which we need to refer to whenever we are determining materiality at the financial level and also at the account statement level. It can be a particular area level also. Okay, so there are very types of materiality, and we will understand like how we should determine at every level. So that is one thing on the types, and we would be covering the determination of materiality. Of course, for determining materiality, we need to understand the industry first, and there are a lot of benchmarks which are available in a financial statement and which would impact the users of the financial statement. We would discuss that, like what benchmark can be used in which scenario. So this is something which we would be covering. And then there would be some case studies which we will run through, and maybe we could keep that session interactive. And then I will be showing you the template once we discuss all these concepts here. So coming to the types of materiality, I think the first thing which I will be covering is the overall materiality. So it's like whenever you start an engagement, okay, at the time of planning, for example, now we need to understand what is the materiality number we should have in mind, so that we could start the audit and we could determine our audit procedures and we could determine our risks of material misstatement. What would be the risk, whether is there any kind of area risk or any other audit risk which we need to consider. And this is all driven by once we determine our materiality number, we understand, okay, this is something, this amount is something which we need to consider while we are planning all our audit procedures. So now the question is, like, how do we plan a materiality number when at the planning stage, when we like normally in the Indian scenario, the financial statements are not yet closed, or maybe it can be in a draft stage or something. So here, I think the critical thing is you need to understand, you need to review the management estimated numbers. And sorry, before again coming to before that, the planning can start even before March. Okay, for example, if you want to plan your audit, if you want to plan, for example, a control testing procedure, you want to strategize your audit, okay, and you want to cover certain things during the interim phase. Okay, so there again, you need to determine what should be the materiality. I think this is somewhere which why it says the standard clearly says you should determine it planning level, and then you should keep on revisiting at every stage. Now, coming to the planning materiality. So now the thing is, we don't have a determined final number, a balance sheet or P&L, which would help us drive us to calculate the materiality. So here, the critical thing is we understand the management estimate, use our professional judgment skepticism to understand whether the estimate considered by the management have covered all the economic aspects. Is there any reason for us to believe that the management would not be able to achieve those numbers? So this is all something which you need to consider while you are determining materiality, overall materiality at planning level. Okay, so this is one step. I think you need to review the estimates and etc. The other step is there is a past history of the entity. For example, it's normally it's a very it's a old entity, or we are doing audit on a regular basis. So you should have the data, the past history of that entity, like how that entity was performing and what is that benchmark or whatever we want to use for materiality. Like how is that being whatever being being like what number that has been coming over the last few years, just to take an average, whether is there any anomaly, is there any abnormal thing which is going on, any exceptional items which are impacting your profitability, or it can be revenue, etc., any exceptional revenue. So this is something which you need to see the past average. Then you understand, okay, this is something very normal, or it can be not normal. Then you normalize it. Then you get to some certain number, and then again you review the estimate. So basis all these factors, you need to determine a number, planning overall materiality. Okay, what would be that materiality? And this is very critical at planning stage, because basis this, you would be able to identify what would be that significant accounts, what would be the significant risks which we would need to cover. Okay, if this entity has a balance sheet with say for example like numbers classified in 10 different areas. So what all areas should be critical basis the materiality determined. So here I think very critical again to determine in the planning stage, and also to understand, because you during the planning stage and strategy stage you also do test of controls. Okay, so test of controls and also you determine, say for example, interim samples. So whenever there is the sample comes into picture, then there is a concept of tolerable misstatement which we would be covering as part of our sampling session, where again the concept of materiality comes into picture, where it is all the tolerable misstatement value, it is all determined the concept of materiality altogether. So this is the overall materiality, and overall materiality, just to tell you some, I think we will be covering that subsequently. So it is a number, it can be like benchmark basis of profit, basis revenue, basis gross profit, net assets, whatever. Like there are a lot of benchmark. It depends on industry to industry. Okay. And then there will be a certain percentage. For example, if it's profit, it's normally between 5 to 10% of profit is the overall materiality. If it's revenue, it's normally between 0.5 to 1%. And then similar, if it's asset, it's 0.5% around. So the percentage changes, and I think there are some, and this percentage there are some enablers which in ICI which enables us to use these percentages. But again, this is not something which is written in the standard, or which or there is a kind of a black and white rule or something. It is something, again, this is only for enabler purposes. And again, if auditor feels that the amount can be lower, higher, or in between, they should use their professional judgment. I think we'll come to this professional judgment when we cover that template. Okay. So this is the concept of overall materiality, and then performance materiality. I think this is something, this is a new concept which I think standard has brought at a bit later stage. It is nothing but it is an amount, the auditor determines an amount less than the overall materiality. Okay, for example, overall materiality is 100, performance materiality can be at, let's say, 75 or 70 or 80 or whatever. So it's nothing, it's about, it acts as a safety buffer to lower the risk of aggregate, uncorrected and undetected misstatement, which could be material for overall financial statements. So if I just want to elaborate more here, for example, like you do the audit completely, you complete the audit, and then you have a materiality, you determine materiality, say of 100, for example. And then basis your overall audit process, you have identified some misstatements like which are, say, corrected or uncorrected, amounting to, say, 95. Okay. So now here, what is the risk? What is the buffer you're having for any kind of undetected misstatements? I think see, whenever you do an engagement, audit engagement, you understand that what could be that the audit is all about true and fair view. It's not about true and correct view, or it's not a certification. It's a true and fair view. We take a sampling approach. We like there can be some detected misstatements. There can be undetected, which which are not come out as part of our audit procedures. Okay, so we should have a like gap. For example, currently the 95 to 100 gap is very small. Okay, if there is something which is say undetected. Okay, and so the margin error to support our opinion, whether it's a true and fair clean opinion, so the the margin is very less. So here because of this, the concept of performance materiality has come into picture. So performance materiality normally, like in the industry, like normally what we have seen practice followed is normally it's around 50 to 75% of overall materiality. And the auditor manages the aggregate of corrected, uncorrected misstatement basis this number. Okay, if this is going beyond, then of course it's a auditor's judgment again to whether it will be a clean opinion or a qualified opinion. Okay, so and this acts as a cushion for the audit. Okay, there is the overall materiality. Overall materiality is something beyond which it would impact the decision of the users of the financial statement. Performance materiality is an auditor which the auditor uses as a safety buffer. Like I would be doing assessing the misstatements till performance materiality level. If anything beyond, then the auditor will take his or her judgment whether it should be qualified or it should be clean if it is not covering the overall materiality. But yeah, it's just to give the auditor a cushion of a probable undetected misstatements, if that can be, that should not impact the opinion. So this is on the performance materiality. And again, coming to specific materiality, we will come to that. I think specific materiality is something which again it is determined at account level basis the risk that particular account is carrying. Okay, so for example, in a manufacturing setup, in a manufacturing industry, revenue can be a significant risk. Okay, or there can be some kind of like investments, or there can be some wherever there is a significant judgments or estimates involved. So that can be a kind of a significant risk. So there, the auditor will determine. I will not be using the materiality as a whole, the performance materiality as a whole. I will not use 100%. Okay, I will use a percentage of performance materiality. Okay, because the risk is higher. So it's a very inversely proportional, risk versus materiality. If the risk is higher, your materiality will be lower. If the risk is lower, your materiality will be higher. Okay. So here, basis the character, the nature of the account balances or account balances, basis the risk of that particular account balances, you determine what is the percentage of performance materiality we would be using to audit that particular account or particular assertion. So here the specific materiality comes into picture. I think again maybe I would cover in the subsequent slide. I think this concept is very simple and very clear. It's the split of performance. It's not split. I would say it's just a percentage of performance materiality we determine. It can be like 10%. It can be 50%. It can be 75%. Basis the risks and control risk. It can be inherent risk. It can be risk of material misstatement for a particular account. Okay, so basis that we determine whether we should take whatever percentage that is suitable for that account. Okay, and then there is a concept of clearly trivial misstatement. So now clearly trivial misstatement is something where you could see whether if you determine a number, it's normally ranges around 5% of the overall materiality. Okay, here it says, for example, any account, if there is kind of any misstatement or any undetected, like unreviewed or not like where we are not like happy with the evidences. Okay, the evidences are not corroborative or persuasive. So there, below this number, you can like as an auditor can ignore. It is believed, it is estimated that the whole overall combination of trivial misstatement across all the account balances will not exceed the overall materiality. So this is something, the number is derived like it's around 5%, what normally again we follow. It's not clearly mentioned as such in the standard, but it is something which is generally followed. Okay, so these are the types of materiality which I wanted to cover. I hope the concept is clear. Maybe if you have any questions, I'll just refer to the chat box if you have any questions for a minute. So, Aryan, the data sharing and I think we can you could check with the moderator. I think they would be having this. Any questions till now? I think the concept is clear. What all materiality we need to use. It's very important. Like you understand this concept. It's not about just get a number and go and audit. Okay, it's about take that number and there are various aspects to that number. Okay, that number drives us to various aspects to cover the entire financial statement. So this is something which we all need to understand clearly. I think on what basis overall materiality is determined, good question. We would be covering that as part of subsequent slide. That is the determination of materiality. That's covered separately. So maybe I'll take more 10-15 seconds. If any more questions, you can just put it on the chat box. Great. Okay. So I think I would suggest everyone to be very open for asking questions. I think it should be interactive. I think we all learn from each other. So you can just ask whatever questions you have. We will try to cover in this session, or maybe if not, then we'll see how we could answer your questions. Maybe the moderator can decide, but you can all at least post the questions. Anyone who could answer within the same group, if not me. So I think I'm happy to share or hear everyone's views on the questions asked. Okay, thank you. So moving ahead. The factors what would be critical in determining the materiality. I think this is something which again is critical, which we discussed briefly just at the start of the session, but let me cover. So it's amount of, like we discussed, amount of material, not material solely by reason of its size. Other factors set out below should be considered in making decisions of the materiality. For example, risk assessment and risk classification. Like before having the materiality, like calculating the materiality, I think the one important thing what we need to do, understand the overall entity risk. Okay, what is the overall entity risk that overall the entity is carrying? So this can be determined by various aspects. Okay, it's not a very again black and white written thing. Okay, of course there are some enablers guidances available. I think even in the enabler what I would be showing it subsequently, I think it is covered. So what all factors you need to see to determine whether, like, what is the overall risk of that engagement? It's low, medium, or high. It is very critical because I'll be covering that subsequently to determine the range of materiality. For example, if you need to calculate overall materiality, if the range is 5 to 10% of profit, so whether you should take 5% or 10%. Okay, so this is something which again a lot of factors drives this. For example, past history of the audit engagement. Like we have seen there are a lot of misstatements that have occurred or that we have dealt with during the past audit of this entity. So this will impact your materiality for the future years. In the past, for example, there were a lot of challenges with respect to materiality discussions or whatnot with the discussion with the management. There are a lot of challenges which we have faced, and there are a lot of critical items. So this will get the risk assessment to the higher side. Okay. And similarly, for example, there are a lot of significant borrowings. For example, it is again there are a lot of borrowings which is again driven by external factors. Okay, economic factors, etc. So where it may happen that you need to determine materiality at a very lower level. It can be, say, for example, a very highly regulated industry. It can be like power sector. It can be a listed industry. It can be like SEC listed, or whatever, the subsidiary of SEC listed in India. So all these factors, then okay, there's something, a lot of challenges, a lot of estimates, professional judgments that would be involved in a particular entity. Then the risk again would go at a higher side. Okay, and then the lower, the medium would be basis if there are no such kind of indicators, you can take a risk at lower level. Lower level of risk means you can take higher materiality. Higher materiality means the samples will be reduced, the overall risk of misstatements will be reduced, etc. Okay, and the second factor which is critical is on the type of organization. Okay, so type of organization, again, as I said, like if the organization is in a particular sector, for example, it is governed by Electricity Act. So like it is something which is susceptible to a lot of regulatory changes and etc. So here there are a lot of challenges and judgment estimates which would come into picture. So here again, we need to assess whether it should be a higher side or lower side. Okay. And any like, for example, if the organization is facing a lot of liquidity challenges, or there are a lot of going concern issues, etc. Of course, the concept of materiality completely changes. Like it may happen that you need to determine materiality at account level. Even that this concept is allowed in the standard. It can your overall, okay, there is one overall materiality, but at the account level you can have different materiality levels. Okay, even that can be there basis the type of organization, the risk the organization is carrying. Okay, industry in which the entity operates, we discussed. So now coming to the benchmarking. So generally, profit is considered to be the most important metric for any user of financial statement. For example, whatever anybody doing business is doing business for profits, to generate profits, right? So any users would be driven by the profit of that entity. Okay, it will impact the decision basis whatever is the profit of that entity. So whatever impacts the user, like what any changes in that particular benchmark, if it is impacting the users significantly, or it's impacting the users as a whole on making some economic decisions on that entity, so that would be the benchmark for an auditor to calculate the materiality. Okay, so generally here, normally, as I said, businesses are normally run for profit. So profit before tax is normally considered to be the important benchmark or metric for any like materiality calculation. And as I said, generally, again, this is generally number, materiality is set at 5 to 10% of PBT. And again, it's not written somewhere in the standard, but this is the general trend, normally what we see. Okay. Now coming to again the determination of PM. So we discussed on the profit before tax, but there can be various other measures what an auditor can use basis the perspective, the expectations of the users of the financial statement. And who would be the users of financial statement? For example, the shareholders would be the users, the bankers if there are any borrowings. The users would be the bankers who would be referring to the financial statement for various like covenant compliances and some whatever regulatory compliances, whatever can be applicable for that particular industry or sector. So they are the users. So we need to understand like their expectation, how they perceive the risk of that entity, how they see the financial statement, what drives their economic decision. Okay, so this is something which I think we all need to understand, like how the users see the entity. Basis that we would be able to use our judgment, use our professional skepticism to determine the benchmark. What is that benchmark, ultimate benchmark we should use? So one is, of course, the earnings based. We discussed like on the pre-tax income. Okay, and let me come to the concept of normalized earnings. normalized earnings is nothing but, for example, during the year, there was some significant exceptional non-recurring kind of like expenditure or revenue that has been generated. So because of that one revenue, your overall materiality is getting impacted for all the all other accounts which are on which there is no change from previous year. Okay, because of that one exception item. So here you need to again determine whether this is normal. This is not normal. As I said, this is just a one-time expenditure that has come, or a revenue. So here, when you are calculating the adjusted profit, so you need to adjust this kind of transaction from your profit, and then you need to see what is that normalized profit if everything is similar to what the company normally does every year. So what would be that profit? Okay, it's there can be general business increase, the sales increase, their expense, general expense increase. That's all okay. That's all normal. But anything exceptional which is non-recurring in nature, which we need to get that to normal, and then we need to use it as a earnings measure. Okay, and then for example, the company is a loss making, or it's a loss at profit before tax level. Then you go a bit, maybe you could see at EBIT level, EBITDA level, where like it's the management must be might be seeing, okay, this is just an interest cost or a depreciation cost. This will not be there in the long run. So this will be something which is temporary. So the users may see EBITDA level also. So the EBITDA may also be a kind of benchmark for determining the planning materiality, and of course then gross margin. And then there are other measures where you could use net assets. Okay, you could use equity, you could use revenues, operating expenditures. Okay, I think there are some case studies. I think we would cover that. But yeah, and this again depends on sector to sector, industry to industry. Okay, for example, there is one investment company. Okay, it's normally does all the investments and all, etc. So the users here are generally interested. Okay, so what is the total assets investment what the company has? Okay, so it's possible that the auditor will determine assets, the total assets for determining the base for calculating the materiality. So it can change. And equity measures come, for example, the company is into liquidation. Okay, so the users will be interested in the overall equity balance of that entity. Okay, so then the equity measure materiality base will come into picture. Okay. So I think we broadly cover this. In certain situations, PBT may not be considered as an appropriate benchmark, like we discussed. This may be situations when the users of the financial statement may not focus on PBT, and then you move to revenue, assets, etc., to calculate the overall materiality. Like investment funds we discussed, trust, like it can be that likely to be total assets, since the focus of the users will be on total assets, considering the nature. Okay, and like for example, again, capital gain sector, investment property company, like they again focus on your total asset value. Okay, so this is something your benchmark should be driven by the users, the expectations of the users. So let me take the questions. So like if you like have posted any. Okay, on what basis is overall materiality determined? I think we have covered it just in the slides. I think I'll just continue if there are no other questions. So performance materiality, like we discussed in depth, I have explained you the concept. Okay, once you determine the overall materiality, which is driven by a benchmark, again, which is again driven by the users of financial statement, you calculate the materiality, overall materiality. Then the second thing which the auditor would be doing is calculate the performance materiality. So, in the last para, as you can see, performance materiality is generally calculated at 50 to 75%, which is a percentage of materiality based on the nature and risk of the entity. As I said, you use a lower threshold when the risk is higher, you use a higher threshold when the risk is lower. Okay, so this is again determined by various factors like what we discussed. So I'll just see if I need to cover, I've missed anything on the performance materiality. Okay. So moving ahead on the threshold. Now, I think this is also we discussed very briefly on the clearly trivial misstatement. So normally it is taken at 5% of overall materiality, and it and it's often considered it's trivial. It's very small. Okay, it will not impact even if it is accumulated at overall level. It will not impact. It will not cross the performance materiality limit. So this is something what we determine. This is on account level when we need to ignore something, ignore some kind of misstatements or something. So this is something determined by the auditors, and it is 5% of overall materiality. Okay. And like if you read the second para, like I was mentioning, if it is anticipated that the accumulated uncorrected misstatements might approach the amount deducted from materiality when determining performance materiality, the auditor may decide to apply lower percentage to determine the actual threshold of what would be considered clearly trivial. So if you see that it is getting accumulated, then you again revisit your materiality, whether we have calculated the materiality correctly or not, and then you again revisit and change the materiality. So revision of materiality is very important and critical as and when you progress throughout the engagement. Even like the revision can be at the end of the audit as well. For example, you have completed the overall audit on a particular materiality level, but there were certain uncorrected misstatements which the management as we as an auditor did not foresee, and the management has taken all those misstatements, corrected all those misstatements subsequently at the closure of the statement. Then again the auditor needs to revisit the materiality. Okay, we understand that at the closure of audit we have completed all our procedures, all the work, etc. But once you revisit, you need to determine, because of this change, what is that something that delta what that has reduced, and what is the delta I have used in my overall audit procedure. You have to just go back and see whether your sampling strategy would change, or whether you need to do some additional samples, or whether you need to see some kind of misstatement that were clearly trivial but that has come out basis the change, that those have become material, like about they have about clearly trivial threshold, etc. So this is something you need to revisit again. So and to avoid all this, it is really important that you use your proper estimate and judgment at the start of the engagement. Whether for example, the management engagement, the client says the profit would be 100. Maybe you need to have all the basis to understand whether this is 100, whether it can be 100 or not, basis the past history, judgment, etc. And also on a very safer side, you can also see whether you could take some kind of haircut. If the management estimates 100, you could say like you take only 95 or 90. Okay, considering there could be some kind of misstatements or thing which management would be incorporating subsequently. So you could also consider this as part of your planning of and determination of materiality. Moving ahead, so as I covered, the common threshold, I think there is a threshold of 5 to 10% for PBT, and for revenue, as I said, there are different threshold which normally ranges. This threshold is for overall materiality. The first one, which is 5 to 10% of PBT, it will be 0.5 to 1%, for example, of revenue. It can be 0.5% of assets. Okay, so this is normally the range what as an auditor we have generally seen we take to determine the overall materiality of an entity. And once the overall materiality is determined, then we move to the second stage to determine the performance materiality. What could be the performance materiality to have that cushion? Okay, whether it should be 25% of materiality or it should be 50%. So basis that you decide whether you should take 50% or 75%. Again, this will depend on the risk, like we discussed. If the entity is at high risk entity, you take the performance materiality at 50% and you keep 50% cushion for any kind of undetected, uncorrected misstatement that could come. So that should not impact your overall audit opinion. Okay, because it would be really challenging, really difficult. Like at the end of audit, like you don't have any kind of cushion available, and you have not made any cushion. So like you found any misstatement. So this, and there are some kind of roadblocks with respect to any kind of a judgmental misstatement where the management is disagreeing to our judgment. So it would be difficult for us to justify or justify our opinion. Okay, like we have given true and fair opinion basis the materiality, but even our materiality is getting crossed by the misstatements. So this would be a challenge for us to give a true and fair opinion, and then we need to again re-perform audit and whatnot. There are a lot of challenges and a lot of practical things which come into picture. So this is why very critical to determine the risk properly, keep a cushion base, and this is why this concept of performance materiality has come up. And then use the performance materiality very wisely at account level, like at what account you need to use what percentage. Okay, basis the risk of that account, the revenue will carry a higher risk. Comparatively, for a manufacturing sector, payroll would carry a lower risk. So payroll, you can use say 75%. For revenue, you can use say 50% of PM again. So this is something which again you need to determine as part of your planning, as part of your strategy. Okay. And then we discussed on the clearly trivial misstatement, which is normally 5% of the overall materiality. We have covered this, the concept of lower, like when to use lower threshold and when to use higher threshold. Okay, like 5% and 10% basis the risk and the chances of misstatement, chances of like the history, what we have seen of that entity, of that engagement. So this is something which we could, the auditor should use again the concept of professional judgment and skepticism to determine the percentage what they need to use. And this is again, this percentage is what is being shown is generally followed. So there is no hard and fast black and white that you need to follow these percentages. Auditors are open to use any kind of other percentages which would fit that particular engagement, particular risk of that engagement. Like we have mentioned here, all the thresholds to calculate materiality are subjective and can be changed at the discretion of the auditor. So maybe before we come to case studies, happy to answer if there are any questions. Okay. So what is normal materiality in case of bank audit, and whether to take PBT of last year or current year estimated? So like bank again, Aryan, it would depend like on like what is that, whether that bank normally sees profit as a driving force for the users, or then like there are some bank may have some net investment, bank may give some loans. So the driving factor can be the assets. Okay. So if it's asset, then you have to take a asset base. If it's a very profit making entity, then you take a profit as a base. And you mentioned that whether to take a PBT of last year or current year estimated. So always you have to consider the estimates, okay? Because it can happen, and then you need to, of course, have a focus on what was there in last year. Because, for example, the last year the profit was say 100, and this year the management is estimating the profit to be 200. So it's a very unreasonable rise, okay? And you see there is no change in the business. It's the revenue terms are similar, and there are no new contracts or no new businesses. So what drives that profit to become from 100 to 200? Okay. So this is something which you need to factor in, and that's why I said like you need to take the estimate, and then you need to determine whether those estimates are correct or not. Okay, and then this will happen basis what many things. There will be many questions what you need to ask, and also your last year history of that entity, like what has been the history for say last 3, 4, 5 years. Okay, and then you understand, okay, this is a normal percentage of profit which we get, but currently there is the estimate is not appropriate. Then you normally challenge it, or then you say, okay, currently if management is unable to estimate, so you take the last year average as a normalized earning for your current year revenue. Okay. So this is something, lot of factors and lot of ifs and buts. I know it's a very subjective concept, the materiality. Okay, there are guiding principles like how to determine what are the types of materiality you should use for each and every account, but ultimately it's a lot of subjectivity and lot of judgment and estimates involved, and what benchmarking you should use, what is the percentage you need to use, whether it should be estimated profit or average of last profits or whatnot. So again, no like hard and fast or a very black and white answer, Aryan, but yeah, you need to consider all these factors like what we discussed. So any other questions? Like I'll take a minute. I'll pause for a minute here. I'll happy to take on any questions still now on the materiality, or else we'll just have some case studies and show you the template. please feel free to ask questions. Okay, I'll just move ahead to the case studies. If no questions, the case studies are very. I think there are 3 to 4 case studies. I'll just present the case study to you, and maybe in the chat box, if you could just share comments, like what do you feel, how the materiality should be. They're very simple case studies. If you could just put your comments on the chat box, basis the facts of the case. Yeah, so the case study one, as you can see on the screen, Unicorn Limited is a listed entity that manufactures and sells office supplies. The entity has been an audit client for a number of years, and the engagement risk has been determined as normal. And it's an audit client for a number of years. So it has almost inconsequential external debt. So there is no like significant debt as well, and the finances most investment by internally generated funds. So it finances by internally generated. There are no debts. It's a very normal risk engagement, etc. So calculate the maturity figures based on the below mentioned detail. The entity has a history of very few identified misstatements. There have been no significant changes in the entity's business, no changes in management or internal control during the period. The profit before tax from continuing operation for the current period is 32 crores 50 lakhs. So maybe basis this, if you could just calculate and let the group know what should be the overall materiality, and what should be the benchmark, and what should be the performance materiality. If you can post on the chat box. Hope the screen is visible with the case study. Yes, PBT will be the benchmark. Okay. Okay. Answers are coming good. 10% should be the overall materiality of the PBT. Okay. PM 75%. Okay. Okay. Trivial 5%. Okay. So thanks. I think I'll just move to the yeah. Yeah, you're right, Aryan. We'll move to the next the answer. So as you rightly said, sorry. The overall materiality would be 10% because the risk is normal, the risk is not higher, so that we can consider the risk as low. So normally, like we have discussed the range of 5 to 10% for PBT. So okay, 3.25 crores will be the overall materiality, and performance materiality again it will be the percentage again within a particular range. Normally we discussed it's 50 to 75. Say for example, you are taken on a higher end, so it can be 75%, and then misstatement 5% of 3.25 crores. I think you all have considered it correctly. So we'll just move ahead to the next case study. And similarly, you could just read and answer on the chat box. So I'll just read it out to you. Clothes and Company is a non-listed entity that sells high-end clothing in 3 different stores located in the same city. The brand is well established since several years back. Many control deficiencies have been identified. Many control had been identified in the past, and the engagement team has assessed its internal control as ineffective overall. Calculate all materiality figures based on below mentioned details. So there have been no significant change in entity's business, management, or internal control during the period. The entity has some external debt, and engagement risk has been determined as normal. Engagement risk is normal. The entity is a profit-oriented entity with a profit of 56 crores. So Okay. I think overall materiality is 5%. Some like others, if higher risk of material misstatement, right? Right. And come to the what should be the performance materiality and what should be the trivial threshold and whether profit is correct. Yeah. Okay. Okay. So Aryan, I think you have mentioned that overall materiality you'll consider as 4%. This is again, okay, 5% is something which you're not comfortable. You just want to go on a much lower side. Yeah, of course, this can happen basis your again professional judgment. So you're like an auditor can determine the other percentages, lower percentages as well, basis the scenario. Yes, right. I think we all have covered correctly. It's 550 and 5, as you rightly mentioned. So moving on to case study 3. So I'll just read out to you. Zila is a listed entity that produces performance enhancing product like protein powders. Of course, the protein it's protein powders. It can be a good booming business in the coming period. So considering the lot of supplements where the new generation is tending towards, so it can be a booming business just on the lighter side. Yeah, the company is well established since several years back. No material control deficiencies have been identified in the past, and the engagement team has assessed its internal control as effective. Calculate all materiality figures based on the below mentioned detail. The company has invested in a new business. I think there's a new fact here. The company has invested in a new business division for performance enhancing drugs, which is yet to be approved by the government of India. There have been no significant changes in the entity's business management internal control during the period. The entity has large external debt and engagement risk has been determined as high. Okay. Entity is a profit oriented entity with a PBT of 30 crores. So maybe like if you could get some thoughts here. So it can be maybe the answer, as I said, the answer it's a very subjective concept. So you could think out of the box and get some more facts here. For example, overall materiality. Okay, you say it's 7.5%, and any other facts basis the new development, you would do something differently. Anyone who want to give some qualitative comments on what, because of this new investment plan where it is subject to the government approval, whether there would be any impact? Yes, Shankar, right. What has been the history of the government approval succeeding, right? Going concern may be affected due to high debt, maybe. Okay. Try to understand the new drug is already in the market to get an idea whether it will be approved or not. Yeah, good thoughts to actually understand whether we need to like reconsider or we need to consider this in our materiality or not. Yeah, these are good facts to know. Right. Okay. So maybe I'll just move ahead. I think it's see the answer here is very clear. Like they have mentioned, like it 550 and 5. But as you rightly said, because this is something specific thing that's happening, you need to assess the going concern. You need to assess whether because the materiality may not apply to this particular product related assets in the balance sheet. Okay, maybe we need to see whether is there any kind of impairment or is there any kind of disclosures or like kind of going concern, like as you rightly said, because of this material, whether this impact the going concern or with the because so much high debt, okay, the entity is carrying, whether they would be how much they would be able to repay the cash flows, okay, for the future, whether they would be able to generate enough cash flows in the future to repay. I think there are very lot of factors which we overall we need to consider to determine the overall risk, and then you see whether materiality should be a monitor. Of course, there will be one monetary materiality, and there will be non-monetary, like we discussed in the earlier slides. If it's non-monetary for this particular asset, we could have a different approach. Okay, so we'll say, okay, we will go beyond our materiality and do some kind of regulatory checks on this particular product. Okay. I think there are more case studies. Maybe we could, considering the time, we could just move to the template here. So I would run you through the template. I think most of you might know and most of you may not know. There is a good template that is available on the ICAI website, which helps the auditors, the ICAI members, for us to enable us to document the overall materiality concept, how to calculate. There are a lot of knowledge, a lot of information available in that template, which would help you to, and it's a very automated template where you could do some kind of tick marks and on. I'll just present it to you. Just confirm on the chat box if you could see the Excel screen too. Let me know if there is a Excel sheet visible for everyone. Perfect. Thank you. Thank you so much. So, as I mentioned, this is a template that is available on our website, which is an enabler kind of. And I think you need to read this disclaimer. I think what has been mentioned here, the utility of the materiality has been prepared for assisting the members for determining and documenting overall materiality, including performance materiality. The benchmarks and the percentage range to be applied are purely suggestive, and the member is required to apply his professional judgment for assessing the risk of material misstatement at the engagement level and then corresponding percentage of the benchmarks. The ICI is not in any way responsible for the result of any action taken on the basis of this template. So again, everything, this is just an enabler. Everything will come to your judgment because you know the engagement very well, the audit engagement, you know the risk of that audit engagement. And then you actually are the heroes on the field who decide, okay, this is the scenario, this is the field. Like, of course, we all are the field members who go and audit, we decide. Okay, so for this entity, we need to carry a lower materiality or a higher materiality. A percentage can be different for different risks, right? So this is something which you should keep in mind. And maybe I'll just move ahead with whatever this template has for you and this utility. And this is easily available for you. I think I would suggest you use this template whenever you all are doing audit. Use this template and then follow this template with respect to all the documentation requirement, because the documentation of your materiality is really, really critical. Okay, it's not about, okay, you just take the financial statement, you determine one number, you go ahead and audit. Okay, there are a lot of you see, there's a simple concept. Everything the work that is not documented is not done. Simple. The same thing applies here. So if you are determining materiality, because it's a very subjective concept, okay, you need to determine your judgment, your reasoning. Okay, like your whatever estimates whatever estimates you have used for your materiality, you need to determine each and everything, and you need to justify why you are using a particular benchmark, whether it's a low risk or a high risk, whether it's whatever the benchmark you are taking. Okay, whether at a account wise you use a different materiality threshold. So everything you need to understand, you need to document that. Okay, so this file is somewhere would help you, this template, to enable you to document all these things. Okay, so please, I would suggest please refer this for our future engagement when we do, if you are not doing already. So there is a guidance available here, like what is the objective of this template, need for determining what is the need, it's general understanding, okay, how we should like document the materiality, or how we need to determine the materiality, and when should we determine, and revisiting. As I mentioned, revisiting is really critical. Like you need to revisit materiality at regular intervals, because if you revisit at the end, there would be a lot of surprises, challenges. With again, we would be bound by time and all, because we do statutory audit. It's bound by a statutory deadline, so we need to revisit it very frequently. Whatever updates or things come up, we need to keep on revisiting. And then types of materiality we discussed, overall performance materiality, etc. And how an auditor should determine materiality as stated in audit report, because we mentioned in the audit report that we have done on a material true and fair view. Okay. And then there are some key definitions given. What would be the total equity when you're using equity as a base? What is net asset when you're using net asset as a base? Revenue, etc. Okay. And what is materiality and what is performance materiality? And then there are some important links where you could refer. All this guidance is available with respect to the materiality documentation. Then moving ahead, there are steps which would help you like assess the risk of material misstatement, and then choosing an appropriate benchmark. Like it depends on, again, we discussed industry to industry, what benchmark should be used, whether it should be a revenue asset. So here, I think there are some kind of guidances available. So if it's a profit oriented, you could use like earnings based measure. If it's not for profit, then like the entity is found with a different objective other than earning profit, then you need to either use their expenses or a revenue, depending on that. And then debt, if it's a debt finance, then again, as I said, you should go on a net asset value. Okay. And then if there is a volatility in profit, then you may need to do a normalized profit calculation to get to the normal profits. And then, of course, liquidity, as I said, you need to go for share capital as a base. And then basis whatever project, if it's a project entity, government entity, then again, it depends on the total project cost or total revenue on that project, etc. So there are different benchmarks and different guidances which this template helps us understand. I think you can see below, like what kind of industry you need to use, what benchmark as a base. I think you could all refer this while determining your overall materiality. Okay. And then they have mentioned a lot of factors here. As you could see here, some of the factors that can be used to determine the percentage are placed below. Like integrity of the management, whether it's a startup, it's a new publicity, ongoing investigations. So again, you refer all this contingent liability and etc., which would help you understand whether there are any ongoing litigation that would impact any kind of numbers or any like profit impacting or any other impacting, prior history of fraud or error. So these are the factors which very extensively, I think they have mentioned here, which we could refer to. I think this is all something, again, it's a kind of tick of a box. And I think there is one sheet which I'd cover, where you just select like how these factors are acting in that particular engagement. Then there is a ratio that comes. Then you determine whether it should be a low risk or high risk, and then you determine your overall materiality. Okay, so this is something we're really good in this template. So you have to refer all this, read all this carefully. And then moving ahead, we calculate the materiality in this sheet. So you have to mention the name of the entity, etc. Everything prepared, reviewed by. We need to also document who is the preparer, reviewer. We always give comments to the client. There is no reviewer control available. We give, but I think even for our documentation, we should have this kind of minimum document information in our work files. So this is how this template is designed. And then if you see the similar factors, what we have seen here. So this is all automated. You have to just say whether it's a high risk or low risk or whatever. So basis this, for example, this is a new engagement. So say it can be not applicable as well, because it can be a recurring engagement. You can select not applicable. If it's a high risk, you can select high risk. It's a new engagement with a high risk factor. Then you, at every level, every factor, like it's a kind of a checklist where you could just select the risk here. And then this is automatically calculated the weightage, like whatever we use like from the drop down. Okay. We give the weightage basis the risk. And then if you come down, basis all these factors and all, then overall, there's an overall risk assessment. Because of all this weightage, what you have calculated here, the overall risk of this engagement comes to 62%. It's a low risk. So then then you take this as a low risk engagement for your calculation of materiality, and then you calculate your further materiality, whether it's a profit oriented So then you mention why you have selected profit as a base because it's a profit oriented. Why you have taken revenue as a base because it's not a profit oriented entity. So we users are focusing on revenue. You should just justify your basis here, and then calculate your materiality here. And then the percentages, whatever percentages you use, as I mentioned, very subjective concept. So you need to determine like what range you're using, what percentage you're using, and why do you feel that this percentage is correct. Okay, you need to mention like what is your thought process to get your materiality number corrected. If materiality number is correct, then I think everything, the audit, you can rely on your materiality, and then you can give your opinions on the yeah. And then, of course, if there are any material misstatement, there is a template which would enable you to document, like if there are any material misstatements, because once you calculate the materiality here, the numbers are automatically carried in this sheet. You document all the adjustments, what errors are uncorrected or corrected in the books, and the cumulative summary of the same. If it is not going beyond your performance materiality, so then you could say it's not impacting the users. So you could give a clean opinion. So this is again a template which you can document. You can just accumulate everything, what are the misstatements, and then you could close your audit in like as a part of this, as a conclusion, you can use this template and close it. So this is some template I think which I would suggest you please go through this template. If you're interested in understanding materiality more, you just follow this template and read the essay 320, which is available again. So, and there is a implementation guide also on materiality available on the ICA website. You could use all this literature available, and then you could determine the materiality. I think I have nothing more on the materiality to share. I think if you have any questions, I'll just pause for a minute, or we'll move to the next topic in 2-3 minutes on sampling. Maybe I would be happy to know like if the concept is clear and everyone is everyone getting something out of this session, some kind of value addition or something, or like happy to hear from you on that as well. So, any questions or any comments you could post on the chat box, or I'll just move to the next topic in in a minute or so. Yeah, thank you, guys. I think there is one question here, what I could see. This means normally PBT is being considered on a basis of overall materiality. See, it's normally, if it's a very normal profit generating company, so then the benchmark would be PBT. And if the users, as I said, you need to see what is the expectation of the users. Users are your bankers. It can be IT department, or it can be your shareholders. Okay, if they see profit is something which is driving them to run this entity or to see this entity, so you need to determine profit. So this is something, and as I said, normally, as you meant, normally if it's a profit generating entity, it's a normal profit, people normally take PBT. If it's not that simple profit entity, then either you go for a normalized profit, or then you go in other measures, like it can be revenue, expenses, assets, etc. Okay, if no other questions, I'll move to the next topic of sampling. Let me just present my screen, and if anyone can confirm if the screen is visible. Is the screen visible? Yes, thank you, Pooja. Okay, so moving ahead to our next topic, which is on sampling. Again, very critical for us, and it's all about basics. The auditing standards are all about your following the basic rules of audit. Okay, so now coming to the sampling concept, of course, like we discussed, you cannot audit 100%. Okay, there are a lot of limitations, a lot of challenges, whether what how to determine whether, for example, there are thousands of transactions. We as a auditor cannot go and audit thousands of transactions. Okay, so we need to determine some kind of samples. Okay, and what should be that basis, whether the number is number of samples what we are using, what we are checking, whether that is correct or not. So this is something which is really important as an auditor to determine whether the quantum of sampling, the coverage of sampling, whether the number is sufficient or not. Okay, and whether because of my sampling, whether I'm covering the overall risk of the population, or whether whatever sample is determining, and that is actual representation of the homogeneous population where I've derived the sample from. Okay, so this is something which is critical, and there is a risk called sampling risk. Sampling risk is your samples may not determine the your samples may not identify any kind of misstatements, whatever sample you're doing, but there can be misstatements in overall population. So this is a sampling risk. And it can be vice versa also. Like for example, there are misstatements in your sample, but there are no expected large misstatement what you're seeing in your sample in the overall population. So these are two different scenarios of sampling risk. The first scenario is something which is really challenging, because if that is the issue, then the overall audit strategy, then the audit opinion will go for a toss. So then we need to understand, we need to go in depth, then we may need to revisit all our audit concepts and audit testing, etc. On the second thing, it will only impact our efficiency, because we have not determined a comfortable level of materiality which we could have. We have taken a risk as a higher level, and we have done a lot of sampling. Okay. So it can happen that, okay, so there is a problem here, but yeah, overall there is not a problem. So this will be a kind of a sampling risk. Okay, the sample may not be represented. That is a sampling risk. If in simple terms I need to tell you. So we'll cover the meaning, objective, the sampling risk, the population determination, the factors, sampling selection methods, and some case studies in our next 30-40 minutes of session. Yeah. Okay. So meaning, objective, I think simple. I think we just for this crowd, I think we all know as the members of the institute that objective of the auditor when using audit sample is to provide a reasonable basis for the auditor to draw conclusions about the population from which the sample is selected. So we should the auditor should be able to determine a reasonable assurance, like when we are giving a true and fair view, and that is why we do a representative sampling. Okay. The application of audit procedure is less meaning sampling is the application of audit procedure to less than 100% item. We cannot test, like we discussed, cannot test 100% of the items within a population, such that all sampling units have a chance of selection. Of course, the way how we select the samples also is very critical, because again, there will be a lot of challenges to explain if there is any kind of judgmental selection, which is allowed as per standards. We can use a sample on a haphazard way or a judgmental way, but normally it's very practically very difficult to again explain why we have selected a particular sample, etc. So it's not so we need to justify the basis why the auditor is I'm sorry, why the auditor is not biased in selecting the samples when you have taken the samples on your own, on your judgment. So here, like the method of selection again becomes very critical. Of course, there are various methods. It can be a random selection, it can be a like monetary unit sampling selection, etc. And so it can be a stratified sampling. There are a lot of options available. How we could do sampling. So I think that is something which we all should understand, and to provide the auditor with a reasonable basis, what we discussed. And the population, I think one thing we all should do, the population completeness is something which is again very important, because if you don't have a correct population, even if you derive samples, you test it, okay, and there are no misstatement. But if the population is not homogeneous, okay, the population is not correct, like for the attributes, for the assertions, what you're testing, whether, and you see that the population has some all different kind of attributes for expenditure, or it can be a revenue or whatnot. So, or data balances. So there are different aspects, and they are not homogeneous. So the population, if population goes wrong, then your whole sampling strategy will go wrong. So very critical, like the population should be complete, and this is something should drive by the, you should drive from trial balance or the balance sheet. Okay, whatever data you are using for sampling, that should come from a trial balance. You should first reconcile the whole population, and then you should see whether the population is homogeneous to the overall attributes which we are going to test or not. That is something which we need to do. So the entire set of data from which a sample is selected and about which the auditor wishes to draw conclusion. So you need to have a comfort on the entire data, on the completeness. Once the population is complete, correct, then you proceed with your further sampling, etc. Right? I've explained you the sampling risk. There are two scenarios of sampling risk. One is in case of a test of control. Okay, let's talk about test of control. When you're doing a TOC, test of control, there are two types of tests. What we do a control testing, we do a substantive testing, test of details. Okay, so in the case of test of controls, that controls are more effective than they actually are. Okay. Or in the case of test of details, that a material misstatement does not exist when in fact it does. The auditor is primarily concerned with this type of erroneous conclusion because it affects the audit effectiveness and is more likely to lead to an inappropriate audit opinion. Okay. So if your sample is not good enough, or it's not representing the population correctly, or they are not identifying the misstatement, but the population has some misstatements. Okay. So then your strategy again will impact your audit effectiveness and will lead to an inappropriate audit opinion. So this is one sampling risk. And that's why there are a lot of measures we need to take when we are doing sampling. Okay. And then the second risk is in the case of test of control, the controls are less effective than they actually are. Like we are seeing misstatement in our testing, but actually there are no misstatement in the overall population. Okay. Same goes with test of details. So this type of conclusion affects audit efficiency, as I said, okay, as it would usually lead to additional work. You have been doing additional work because you have found some kind of issues in so then you do a lot of additional testing which may not be required considering the overall materiality. Okay, and this will lead to then to establish that initial conclusion is incorrect. So this is the sampling risk what we carry. So just I'm going back to the previous topic. Materiality is very critical when you're determining sampling. Okay, it's the overall materiality concept, whatever you calculate, will drive, because you see everything is linked. All the auditing standards, okay, all should marry each other. Okay, all should be we should ensure everything is complied with. If any one of the standard fail, the overall audit strategy fails. So considering at least these two topics which we are covering today, if materiality fails, your sampling will fail, definitely. Okay, because you have not used the right materiality levels. So we need to be very careful while we are determining materiality. At least we'll stick to materiality now, because this will impact sampling also. Population, I think I discussed briefly. The population for sampling should have the following characteristics. Okay, the sample, okay, one is the completeness of population, and also there are a lot of factors which we need to ensure whether the sample, whether the population is representing, and whether it is homogeneous or not, whether the sample, what the attribute we are going to test, the assertions what we are going to test, okay, whether that is suitable for this population on an overall basis or not. So firstly, we discussed on the completeness. The population on which the auditor is to perform the procedures to identify any misstatement should be complete in all aspects. Okay. If any outlier are found, auditor has to re-perform the complete procedure, then we need to see, but it should be complete. Okay. Like monetarily, it should tie up with your trial balance. If there is a reconciliation item, there should be you should reconcile. The auditor should ensure the audit of reconciling item either through some other procedure or again through some other population. Okay. And the second thing is it should be homogeneous. All the items of the population should be homogeneous. Like I said, it should carry a similar character. Okay, and it should have same nature. For example, if you're doing a revenue testing and you're testing an attribute of, say, for example, invoice testing. Okay, and you have two types of revenue. One is revenue on POCM basis, which is over the period of time, and one is at a point of time, okay, which is a normal revenue recognition basis, the risk and reward or the controls. So if you combine these two, so then these are not homogeneous, okay. So these are two different type of populations and different type of balances, which needs to be considered for testing separately. It cannot be clubbed, okay. So this is what we're trying to say here. And appropriateness, the auditor should always be clear on sampling for which area of audit is to be performed, and the population is to be prepared accordingly. For example, whatever assertions we are testing, it can be measurement, occurrence, okay, it can be valuation, existence. For example, existence, the data's balances, inventory balances, whether the sample is actually suitable for us to test that assertion or no. Okay, so this is something again you need to say. For example, for a data, you need to have entire data listing, okay, to see whether whether there is some kind of existence issue or not. Okay, so this is something which which you need to consider the appropriateness. Okay. And now, see, coming to, there are various factors that would affect your entire sampling population, right? Whether it should be a higher higher sample size or lower sample size. There are various factors that drives. Okay, there are some factors which I have just presented it on the screen. For example, there is a there's an increase in tolerable rate of deviation from expected conclusion. So I think let me explain you the concept of tolerable misstatement. Okay. So we discussed in our earlier part in the materiality section, the concept of performance materiality. Okay. And also we have discussed the concept of allocation of performance materiality to a specific account. So now when basis, like we discussed, basis the risk of that account, whether it's a significant risk, high risk, low risk, medium risk, we determine a particular percentage, okay, of a performance materiality for that account for further audit procedures to be planned for that account. Okay. So here, this is called tolerable misstatement. What is a tolerable misstatement for that particular account? So here, for example, higher the tolerable misstatement, your sample size will be lower, okay, because the materiality will increase. If the tolerable rate of the deviation is decreasing, your sample size will increase. It's inversely proportional. So again, the materiality, as I said, the materiality is very key to be determined correctly, because it will be used in your sampling strategy as well. Then the second factor, like an increase in the auditor's desired level of assurance. For example, you want a very high level of assurance, persuasive evidence from the sampling, and there is no other procedure which you would be doing for that particular assertion. So then the sample size would increase in these scenarios, because you need to do some additional sampling, maybe to cover additional coverage, etc. Right? And an increase in the auditor's assessment of the risk of material misstatement. For example, the auditor basis his assessment. For example, earlier it was a low risk of material misstatement, but during the course of audit, it has come to his knowledge that the risk will be higher and not a medium or a lower risk. If it increases, then again your material thresholds will increase. The percentage of tolerable misstatement will increase, and then your sample, of course, it will impact your, sorry, the tolerable error percentage will decrease, and it will impact your sample size, right? and then increase in the use of other substantive procedure. For example, if you are auditing a particular assertion, measurement and occurrence for say revenue, so you are using a particular number of sample, but you are having a alternate procedure. You're doing one more additional procedure to cover the similar attributes, the same assertions. So then if you're relying on some other procedure, then again your sample size will reduce. Okay, so again this judgment and this everything, this will all drive your this tolerable misstatement number, and this will drive your sample number. So maybe I'll just take a pause for like few seconds if there are any questions on the screen. Like any questions, like you can just post it here till now. Okay. So I'll just move to the next slide, considering no questions. Coming to sample selection method, I think this is very important for us to understand. Okay, one is sampling. Then how to, when you determine, okay, this is the number of samples we need to test. Okay, basis your materiality levels or like the tolerable misstatement levels, what we have calculated. So now to determine like what method to use. There are some methods what the SA 530 suggest. I think there are 4 to 5 methods that they have suggested, which we could use. Okay, I think we'll just run through one by one quickly. One is on the random selection. Okay, so random selection is nothing but selecting the samples in the entire population on some statistical random technique. Okay, so like there are random tools available. These are Excel based tools also, and there are other tools also available. So you could use like these kind of random tools in your sampling method, where the chance of every population line item getting picked is equal. There is no kind of biasness, unbiasedness, or whatever, which would impact your sampling strategy. So this is normally random selection we normally take for test of controls, okay, and even in some situation for test of details, where we want to give an equal chance to the entire population, and the entire population is completely homogeneous, and there is no stratification required. I'll come to stratification, but this is something which where this method would be suitable, which we could use. And then coming to systematic selection. Systematic selection is nothing but very simple. You need to, for example, if there is an entire line item of population, there are, for example, 1,000 line items, and then you determine by, okay, so I have to select, say, 25 sample, basically audit judgment and estimate and whatever the auditor determines. Then you divide the population, and then you say, okay, we have to select, say, 50 samples. Okay, and there are say 5,000 line items. Okay, so you like determine the interval. What is that interval we need to use? Okay, to get 50 samples, equal interval. Okay, so here the thing is your samples will be on a very like interval to interval, like every 100th number will be a sample. Okay, till you reach 5,000. So every 100th number will be a sample. That is how you select, do the sample. It's a very one of the strategy what normally people follow as well. And I think the one important thing type is the MUS, monetary unit sampling. So this is also very widely used sampling technique. Here it is a value weighted selection. If you use MUS sampling technique, it normally gives you samples basis the value, okay, value as well. Not only the random, and it's a combination of random versus weighted value selection. Okay, in this, like if you want to have a lot of good coverage basis the risk, for example, the risk is higher, and we want to cover the value wise also, and also we need to ensure the chance of selection of the samples equally for all other population. So we could use a monetary unit sampling method. So this is also we can use, and normally this kind of method is followed for our test of details, like in random selection is normally followed for control testing and some substantive test of detail procedure as well. But majorly for test of detail, where we intend to cover the a bit of larger population number value wise. So we use monitor unit sampling methods. Haphazard selection, again, it's something where it's a judgmental thing. It's a basis the professional judgment, skepticism, what the auditor. It's very non-statistical, okay, and so it's basis the auditor's estimate, judgment, etc. So here the only thing is again the problem. It's not widely used technique normally. Okay, it can be combined with the MUS, the monitor unit sampling or random technique or any the other the first three techniques what you it can be combined with that, but normally if you are using it like on a standalone basis, so you and there can be a lot of subjectivity biasness which you may need to explain, like what is the why is the reason you are selecting the sample in a haphazard manner in a judgmental basis, and why you have selected a particular sample, what is the reason and what is the basis, etc. This is something which again auditor needs to document and justify the sampling technique. And block selection, again, normally it's very it's not followed in a very this is like selection of block of contiguous items, similar nature items, where like you could see, but you could see that block there are different blocks of population, and then you need to select samples from each block. And normally it is not followed very widely, because it's normally the population is either similar in nature, it can be same, it can be homogeneous, so it's not ideally followed technique, the block selection. So these are like 4 or 5 techniques which is available in the guidance, in the standard, which you could refer to and you could apply in your audit methodology. So any questions? Maybe I could pause for a minute or two here for any questions. I think we have a lot of questions on materiality. I think would be great if you could also post questions on sampling, and then we could discuss if any kind of questions or queries or any thoughts, whether the concept of sampling is clear. Like, so I think one question, how materiality and sampling are correlated. So see, uh, like we discussed, when you're sampling, I think there is a concept of, like I mentioned, on the tolerable misstatement value, which would help us to determine what would be that percentage. Okay, for example, you have determined a materiality of say 100, and then you have a tolerable misstatement of say 25. Okay, then the auditor takes like sampling technique that all the value transactions above 25 needs to be tested for that particular calculation population. Okay, and also this will determine your number of sample, whether in your test of detail, okay, whether you should test, say for example, I'm just taking a random number, you need to test 10 samples or 20 samples or like 30 samples. Okay, this will be driven by that number tolerable misstatement, which is again derived by your materiality. Okay, so this is how your materiality is linked to the sampling. Okay, the sampling technique, and this is majorly for your test of detail. I think for the controls and all, normally it's basis risk. Okay, so and risk and the number of occurrences. So it's normally the ICI guidance suggests a certain number of samples you needs to be tested. Okay, to determine whether a control is working effectively, operating effectively or not. Do we have any ready-made template for sampling? I think on the I'm not sure on the ICA website. Maybe we could we could check this question. Maybe I could answer separately, or yeah, Chandan, like if you could answer if there is any kind of template.
It is available on institute website. The materiality template can be used, and all the calculations, various parameters there. Can go and see on the ICI tools and resource section. Or even you can write an email to an ICI, and if you don't find it, they will share.
Yeah. As a part of the session, we have Chandan covered the materiality template, but I think here it was not part, so I have not covered it. But yeah, if it's available, that's great. I think everyone can refer to that template. Thank you, Chandan. Okay, so let me move to the case studies. The last topic. We'll run through some case studies, and again the same thing what we have done for the materiality. Please go through the case study, and if you could post your comments, like what could be in this scenario, how the sampling should be strategized. So we would see from case by case. So there are some 3 or 4 case study we'll complete, and then we'll conclude the session. Okay. So you can read on the screen, an auditor of a retail company with multiple locations and a diverse product line wanted to ensure that its revenue recognition practices were in compliance with accounting standards. The company processed thousands of transactions daily. Okay. As an auditor of the company, decide the sample selection technique. Okay, it's a very, I think, open, general kind of scenario. I think we're happy, like if you could come up with your thought process, like what could be the approach here, like what we should follow basis, whatever we have like discussed till now. If anyone can post it on the chat box on this. Okay, the one answer is random basis. Okay. Any other thoughts, or you can be open, like give your comments. It's all like it can be subjective comment, or it can be like any other basis. Any more comments on this? Okay. If no more comments, I'll just move to the approach. So if the auditor again wants to perform, like I said, substantive TOD on the area, like I mentioned in the slide, like if it's a substantive test of detail, normally we prefer a monetary unit sampling because it's a very value weighted average and also covers the random selection. So this is something, if you're doing a test of detail, you normally tend towards monetary unit sampling because it's likely to cover more risk in terms of monetary value, like we discussed. But if it's a like controlled testing procedure, like again we discussed in the earlier slide, then statistical random sampling is more accurate because it will unbiasedly cover all the population, and the chances of eliminating risk of not finding a control deficiency will decrease. So we'll cover the entire population equally. Okay. So the scenario will change, like we discussed, for test of details and test of controls. Okay. Moving to the next case study. An auditor of a service company wanted to assess the collectibility of its accounts receivables. Okay. The company had numerous small and medium sized accounts. So as an auditor, decide the sample selection technique. It's about existence, the collectibility of accounts receivable. So any comments on this? Not only selection method, you can mention other things like other thoughts on sampling strategy for these kind of scenarios. Anyone? Okay. So based on aging, that's a good answer. I think based on aging, I think that is because basis the age you can stratify. Okay, for example, if it's beyond say expected timeline duration of the receivable, and then you see that there is a risk of the collection, then you tend to have those in the sample. I think that's called stratified sampling. I think that's one of the concept we wanted to cover in this. It's about like how you stratify your population on value wise, on a like nature character of that account, and then you determine what weightage needs to be given in a particular population, and what in other population the weightage will be smaller weightage. That's how you stratify, and that's very well answered on that. Based on aging will be one kind of scenario which we could do. And here on this approach, the auditor should opt for a again value MUS basis to ensure the sample were representative of the receivable based on their monetary value, and identify several high value that were risk of being becoming uncollectible. And in addition to this, yeah, aging is something which we could do as part of our stratified sampling. Great. Moving to the next case study. An auditor of clothing company with multiple locations and a small product line wanted to ensure that its expenses are accurately booked and were in compliance with accounting standards. The company has only a few type of expenses which are similar in nature. As an auditor of the company, decide the sample selection technique. So again, any comments on this? Okay, if no comments, I'll just move it on the solution. Yeah, I think there was one comment. Just okay, based on random. Okay, if the auditor wants to perform substantive test of control, the random selection technique is accurate because every expense will have an equal chance. Right. Okay, fine. Moving ahead to the last case study. An auditor of software company wanted to test the accuracy of employee details from the employee register. The company had a large number of employees and no other major expense. There's only employee expenditure in this company. And as an auditor, decide the sample selection technique. Again, what should be the sample selection? It's a very simple one again. Any other qualitative thoughts are welcome. Like what more information or what more would you do apart from normal sampling in these kind of scenarios? Or anything different, what you have dealt in your engagements, in your audit engagement, in your career, whatever. Okay, there is one comment. Employees who have been in the company for long should be picked up. New joiners and permanent employees should be picked up as samples too. Yeah, of course, that will like Gaurav, it will depend. Like it's a kind of stratified thing. Again, what you're doing, basis company to company, where you feel that you need to identify the existing employees separately, and the new joiners and leavers should be identified separately. Yeah, that is a thing what you need to do for stratification purposes for a better sampling coverage to cover all the employee related risks. So it's a see again. It's a very suggestive thing. It's depends on your judgment on like at the ground. Like we normally like how we handle the situation on the ground. What we know the situation on the ground, so we decide what approach needs to be followed. But it's a indicative approach. What the standard suggests the auditor should opt for a combination of random selection and systematic selection, wherein the first number is selected on a random basis, and the number will automatically get picked up on an interval. This is on judgment basis. Okay. So this is something. That's it from my side, guys. I think on both critical concepts of materiality and sampling. I think we discussed. I think I'm happy if there was some kind of value addition that has happened after this session to you on understanding the concept and how to use the templates of materiality and how to use materiality at every level of audit and how to use your materiality in like sampling procedure and how to do sampling. Okay, so audit is I think we need to use all these judgments and we need to document all this, like what basis what we are doing, the basis what we are doing with respect to all this auditing standard determinations of materiality, etc. That would help us justify our opinion on the financial statements. So thank you very much. I think it was really pleasure and good opportunity for me to interact with you all to deliver this session, which is one of the very critical and key topics. And thank you to the entire committee and Chandan who's here. Thank you very much. I think Chandan, I can conclude, and that's it from my side. On my side, thank you so much.
Thanks, Nikhil. Thanks for such a wonderful session, and thanks for taking out time to deliver this session out of your busy schedule. I think so. Very well covered about how and when materiality to be calculated and how it need to be implemented as part of the audit. Definitely, all the participants might have gathered a lot of insights and they will use that in next 1.5 months from the statutory audit perspective. That was equally an intention from an WRC perspective. Still, if you have any questions, you can reach out to Nikhil anytime on materiality, and he will help you, guide you on this particular topic, or you can reach out to me. Definitely will help you to work around on the materiality perspective. Officially, once again, thanks to Nikhil from WRC and from all the participants. We can close today's session and can close the recording.
Thank you, Chandan.
Thanks to everyone. Thank you. Thanks, Nikhil.
Thank you.
Thanks.
Thanks. Yes.